Ladies and gentlemen, Asian guy here. If you watched our last update, you know the ground has shifted beneath our feet. We exposed the banker flip. We showed you the CFTC documents proving that JP Morgan and the US giants have exited their short positions and gone net long. But that was only half the story. That was the good news. Today, we have to talk about the blood. Because in the world of zero-sum financial warfare, for a winner to exist, a loser must die. And we have found the body. For decades, we thought of the banks as one monolithic entity. We thought of them as the cartel, a unified group of US, European, and Asian banks all holding hands, singing Kumbaya, and smashing the price of silver together. We were wrong. They weren't holding hands. They were holding knives behind their backs. The data we are looking at today proves that the alliance has shattered. The US banks didn't just exit the market, they executed a strategic betrayal of their international partners that makes the red wedding look like a children's birthday party. We need to talk about the non-US bank category in the bank participation report. This is where the bodies are buried. This is where the 215 million ounce short position is currently sitting. Who are these people? These are the giants of the Eurozone. These are the bloated zombie banks of the old continent. These are the Canadian behemoths who have lost their way. And these are the Asian state banks who thought they were playing a hedging game, only to find themselves trapped in a speculative death spiral. Let's look at the suspects. We know that historically, banks like Deutsche Bank, HSBC, Barclays, and Scotiabank were the heavy hitters in the precious metals markets. For years, they operated in lockstep with the US giants. They moved liquidity back and forth across the Atlantic to keep the price of silver contained. It was a symbiotic relationship. The US banks provided the political cover with the regulators, and the foreign banks provided the raw balance sheet leverage to flood the paper market. But something changed in late 2025. The US banks, specifically the Big Four, saw the writing on the wall. They saw the Basel III requirements tightening. They saw the physical drainage from the COMEX. They saw the BRICS nations hoarding metal. And they made a cold, calculated decision. They decided to dump their toxic short positions onto the books of their allies. They sold their shorts to the Europeans. They convinced the foreign desks that the rally was fake, that silver would crash again, and that taking on these short positions was free money. The European banks took the bait. They swallowed the hook, the line, and the sinker. And now they are choking 215 million ounces. I want you to visualize that amount of silver. It is a mountain. It is roughly 6,600 metric tons of silver. It is more than the entire registered inventory of the COMEX. It is more than the LBMA has available for float. And these foreign banks are betting that the price goes down. They are shorting a market that has already broken out. They are standing in front of a freight train with a piece of paper that says, "Stop." Why is this specific to Europe? You have to understand the fragility of the European banking system right now. The Eurozone is already on life support. Their economy is stagnating. Their energy costs are skyrocketing. Their industrial base is collapsing. The last thing, the absolute last thing, the European Central Bank, ECB, needs right now is a solvency crisis in their major investment banks triggered by a commodities desk blowout. But that is exactly what JP Morgan has engineered. Think about the timing. Why now? Why did the US banks flip in December? Because they know that January and February are traditionally the strongest months for physical demand. They handed this bag to the Europeans right before the seasonal spike. This wasn't an accident. This was a hit job. The US banks have effectively weaponized the silver price to destroy their competition across the Atlantic. By going net long, JP Morgan now has an incentive to drive the price to $100. It's not just to make money, but to bankrupt Deutsche Bank, to cripple Barclays, to force a liquidation event that secures US financial dominance for another 50 years. The foreign banks are now the bag holders. In finance, being the bag holder means you are the one left holding a worthless asset, or in this case, a liability that goes to infinity, when the music stops. The 215 million ounce short position is a liability that grows every single time the ticker on your screen ticks up by 1 cent. At $30 silver, they were underwater. At $35 silver, they were drowning. At $50 silver, which we are rapidly approaching, they are insolvent. We are talking about losses in the billions. Not millions, billions. If silver moves $10 against a 215 million ounce position, that is a $215 billion loss instantly. Mark to market, gone. Vaporized from the balance sheet. And remember, these banks are leveraged. They don't have $2 billion in cash, just sitting around in the precious metals desk drawer. They are trading on margin. They are trading with borrowed money. A $2 billion loss on paper can trigger a $20 billion margin call, depending on their leverage ratio. This is why the silence from Europe is so deafening right now. Have you noticed? No press releases. No confident statements from European CEOs. They are quiet because they are terrified. They are currently in emergency meetings in Frankfurt, in London, in Paris, trying to figure out how to unwind a position that is too big to exit. You cannot buy back 215 million ounces of silver without sending the price to $500. They are trapped in a room with no doors, and the water is rising. The US banks know this. That's why they flipped. They aren't just betting on silver, they are betting on the collapse of the European short sellers. It is the ultimate predator move. And for us, the investors, the stackers, the people who have held physical silver for years, this is the moment of truth. The enemy is divided. The cartel is in a civil war, and when giants fight, the ground shakes. We are watching the prelude to a default. Not a default of a small mining company, not a default of a local coin shop. We are watching the potential default of a G7 banking institution on its silver obligations. The sheer size of this short position, 215 million ounces, makes it a systemic risk. It is a black hole that threatens to suck the entire global futures market into its event horizon. And do not think for a second that the regulators will save them. The CFTC is a US regulator. Their job is to protect the US markets. If a German bank or a French bank blows up because they made a bad bet on silver, do you think the US government is going to bail them out? No. They will let them burn. They will use it as an example. They will say, look, the market works, bad actors were punished. Meanwhile, the US banks walk away with the profits. This is the narrative you aren't hearing on CNBC or Bloomberg. They will tell you silver is volatile. They will tell you it's a speculative frenzy. They won't tell you that the oldest banks in Europe are currently staring down the barrel of a loaded gun held by their American partners. This is a financial execution, and the execution date is fast approaching. The option's expiration looming next week could be the trigger. As we move into the mechanics of this in the next part, I want you to remember one thing. There is no honor among thieves. For 40 years, they worked together to rob us. But now, the loot is running out, the silver is gone, and they have turned on each other. The 215 million ounce short position is the death warrant for the old financial order in Europe, and the ink is already dry. Now that we have identified the victims, the European, Canadian, and Asian banks holding this toxic bag, we need to understand exactly how the guillotine drops. We need to talk about the mechanics of a cross-border margin call. This is not like you or me getting a notification on our brokerage app that we need to deposit $500. This is institutional plumbing, and it is about to explode. When a European bank holds a short position on the COMEX, which is a US exchange, they are operating in a hostile environment. They have to post collateral. Usually this collateral is in US treasuries or US dollars. As the price of silver rises, the exchange requires more collateral. This is called maintenance margin. Every night, the exchange marks the position to market. If silver goes up $1, the exchange calls the bank and says, you lost $215 million today. Wire it to us. Now, here's the problem. The European banks are currently facing a liquidity crisis in US dollars. This is known as the euro-dollar shortage. They have plenty of euros. They have plenty of European sovereign bonds. But the COMEX doesn't want euros. They want dollars. So, as silver spikes, these foreign banks have to scramble to the currency markets to swap euros for dollars to pay their margin calls on silver. This creates a feedback loop. By frantically selling euros and buying dollars to cover their silver losses, they are inadvertently driving the US dollar index up and the euro down. But here is the kicker. Usually, a strong dollar is bad for silver, but in this specific scenario, the dollar is rising because of the silver squeeze. The correlation has broken. We are seeing a situation where silver and the dollar can rise together, driven by the panic of foreign banks. Let's go deeper into the plumbing. Most of these foreign banks don't just trade on the COMEX. They also trade on the LBMA, London Bullion Market Association, and the OTC, over-the-counter market. The LBMA is the heart of the vampire. It is where the unallocated accounts live. An unallocated account is when you pay a bank for silver, but they don't actually set any specific bars aside for you. You just have a claim on the bank's general pool of metal. The 215 million ounce short position we see on the CFTC report is likely just the tip of the iceberg. It is the visible hedge against a massive unallocated liability in London. These banks have likely sold billions of dollars worth of paper silver to clients in Europe and Asia, silver that doesn't exist. They use the COMEX futures to hedge that exposure. But now that the US banks have flipped long, the hedge has become the noose. Imagine you are a risk manager at a major French bank. You come in on Monday morning. Silver is up $3 overnight because Asian markets panicked. Your screen shows a loss of $600 million on your short book. The phone rings. It's the margin clerk from the New York Mercantile Exchange. They demand $600 million in T-bills immediately. So you look at your liquidity buffers. You realize that to raise that cash, you have to sell profitable assets. You have to sell stocks. You have to sell bonds. You have to raid other desks to feed the silver monster. This is how a bleed out happens. It starts in the commodities desk, but it drains the lifeblood of the entire bank. And remember, these banks are interconnected. They have counterparty risk with each other. If Bank A in France defaults on a margin call, the clearinghouse has to step in. But who funds the clearinghouse, the other members, the US banks? Do you think JP Morgan wants to bail out the French bank? No, they want to absorb them. They want to buy their assets for pennies on the dollar. We are witnessing a hostile takeover of the global silver market disguised as a short squeeze. The US banks are squeezing the foreign banks until they vomit up their physical inventory, because that is the only other way to settle a short position. If you can't pay the cash, you can deliver the metal. You can load 215 million ounces onto a boat and ship it to New York. But they don't have the metal. That is the critical point of this entire documentary. They don't have it. 215 million ounces is 25% of annual global mining supply. It is gone. It is in Samsung factories. It is in Indian jewelry boxes. It is in your safes. The vaults in London are reporting record lows. The float, the metal actually available for sale, is virtually zero. So the foreign banks cannot deliver. They are forced to stay in the paper market, forced to buy back contracts at higher and higher prices, forced to bid against themselves. This is the definition of a melt-up. It is what happens when a short seller has infinite liability and zero deliverable product. The algorithms know this. The high-frequency trading, HFT bots that scan the news and the data, have realized that the foreign banks are cornered. The sharks smell blood. The algorithms are now programmed to front-run the European covering. Every time a European bank tries to buy a contract to close a position, an algorithm steps in front of them, buys it first, and sells it to them for a nickel more. Death by 1,000 cuts. And what happens when the margin call is finally missed? What happens when a major bank says, we can't pay? That is the default event. The exchange will immediately seize the bank's remaining positions and liquidate them at market. At market means at any price. If the order book is empty, the computer will bid $50, $60, $100, $200 until it finds a seller. This creates a vertical line on the chart, a flash super spike. In 2020, we saw oil go to negative $40 because of a mechanics breakdown. In 2026, we are going to see silver go to positive infinity for a brief moment because of a mechanics breakdown in the opposite direction. The clearinghouses are not prepared for a default of this magnitude. They have insurance funds, sure, but those funds are designed for normal market volatility, not for a rogue wave caused by a structural shortage of the underlying asset. The Europeans are realizing they have been played. They were the useful idiots of the suppression scheme for 40 years. They helped the US maintain the dollar's hegemony by smashing gold and silver. But now that the dollar is dying, the US banks are cutting the dead weight. They are sacrificing their allies to survive the transition to the new system. It is ruthless, it is Machiavellian, and it is happening right now in real time. The cross-border nature of this makes it a diplomatic nightmare. Can you imagine the phone calls between the German chancellor and the US president? Your banks are bankrupting our banks. And the US response will simply be, it's a free market. You took the bet. You pay the price. There's no bailout coming from America. The Europeans are on their own. And the Canadian banks? They are even more exposed. They have been heavily shorting precious metals for years. The Scotiabank exit from metals a few years ago was a warning sign. They knew. The smart money left. The ones remaining are the ones who didn't understand the game had changed. Now, they are holding the bag in a market where the physical miners, many of whom are in Canada, refuse to sell to them at spot price. The miners are holding back supply, creating a pincer movement. The miners squeeze from the supply side, the US banks squeeze from the paper side, and the foreign banks are crushed in the middle. This mechanism, the margin call cascade, is unstoppable once it begins. It is a mathematical inevitability. The leverage that was used to suppress the price is now the leverage that will catapult it. For every $1 rise in silver, the pain for these banks increases exponentially. And with the US banks pushing the price up, the pain dial is being turned to the max. We have covered the betrayal. We have covered the mechanics of the margin call. Now we need to zoom out and look at the blast radius. Because if you think a massive silver default stays contained to the silver market, you are dreaming. This is the butterfly effect on steroids. A default on the silver desk of a major European bank is the spark that blows up the entire global derivative bubble. We need to talk about the European Central Bank, the ECB. They are staring at a nightmare scenario. They are already dealing with high inflation, a fracturing Eurozone, and sovereign debt crises in the southern member states. Now, imagine if Deutsche Bank or BNP Paribas comes to them and says, we have a $20 billion hole in our balance sheet because of silver. And what does the ECB do? If the ECB prints money to bail them out, they devalue the euro even further. This causes inflation in Europe to spike, which causes the public to panic buy hard assets, like silver, Do you see the trap? If they bail out the banks to cover the silver short, the money printing drives the price of silver higher, which makes the short position even bigger. It is a doom loop. They cannot print their way out of a physical shortage. You can print euros, but you cannot print ounces of silver. This brings us to the Lehman Brothers moment. In 2008, it was subprime mortgages, a specific toxic asset class that infected the balance sheets of every major bank. In 2026, it is the naked short position on precious metals. The contagion works through counterparty risk. These foreign banks are counterparties to trillions of dollars in interest rate swaps and currency derivatives. If they become insolvent because of silver, they cannot honor their other contracts. Suddenly, the bond market freezes. The repo market freezes. Trust evaporates. Banks stop lending to each other overnight because they don't know who is holding the massive silver bag. Is it you? Is it you? When banks stop trusting each other, the global financial system grinds to a halt. ATMs stop working. Credit lines are pulled. This is the contagion, and it all starts with a seemingly small market, silver. The silver market is tiny compared to the bond market. It is a pimple on the elephant's back, but it is the pimple that causes the infection that kills the elephant. Because silver is real money, it is the canary in the coal mine. When the price of silver disconnects from the paper manipulation, it signals that the fiat currencies are worthless. It destroys the illusion of value that the central banks have spent 50 years building. The US Federal Reserve knows this. That is why they are allowing this to happen to Europe first. It is a controlled demolition. They want the chaos to happen over there so that capital flees Europe and runs to the US. They want the world to see the euro collapse so that the dollar looks strong by comparison. It is a cynical, dangerous game. The US banks are using the silver squeeze to drain the liquidity from Europe and Asia back to Wall Street. But there is a risk, a massive risk. If the panic spreads too fast, it could blow back onto the US banks too. Even though JP Morgan is net long, they are still part of the same banking ecosystem. If Europe collapses, the US economy suffers. So we are walking a tightrope. The US banks want to squeeze the foreigners enough to make billions and destroy their rivals, but not enough to end the world. But can they control it? Can you control a forest fire once you start it? History says no. When panic takes over, human psychology drives markets, not algorithms. We are looking at a potential force majeure event across the entire London banking sector. The LBMA might declare that they are suspending trading. They might say, due to unprecedented market conditions, we are halting all silver settlements. This would be the death knell for the paper market. It would bifurcate the price. You would have the official price, which is frozen at, say, $50, and the Yonah Street price, or black market price, which is trading at $150 or $200. The European banks would try to settle at the frozen price, but the physical market would ignore them. This disconnect creates chaos for industrial users. Samsung, Tesla, Apple, they need physical metal. They don't care what the paper price says. If the European banks can't deliver, the tech giants will bypass the banking system entirely and go direct to the miners. This destroys the bank's relevance. The contagion also spreads to gold. Silver is the volatile little brother, but gold is the heavy artillery. If the silver shorts blow up, the gold shorts will panic. The same banks shorting silver are shorting gold. The margin calls on silver will force them to liquidate their gold positions too. We could see a simultaneous explosion in both metals. This is the precious metals reset that the conspiracy theorists have talked about for years. It is no longer a theory. It is a mathematical certainty based on the leverage ratios we are seeing in this report. And what about the Asian banks mentioned in the report? The state banks of the East? They play by different rules. If a Chinese bank is trapped in a short squeeze, the CCP might intervene. They might nationalize the loss, but they will also take revenge. They might dump US treasuries in retaliation. This brings the contagion into the sovereign debt market. A silver squeeze could trigger a US treasury dump, spiking interest rates and crashing the real estate market. Do you see how connected everything is? You cannot isolate the 215 million ounce short position. It is a live wire connected to the dynamite of the global debt bubble. The US banks have lit the fuse by flipping long. They think they can manage the explosion. They think they are safe in their bunker. But the shockwave is going to be bigger than anyone anticipates. The ECB is likely preparing emergency measures right now. We might see capital controls in Europe. We might see bans on purchasing physical silver to protect the stability of the financial system. When a government tells you that you can't buy something, that is the exact moment you need to own it. The actions of the authorities during this crisis will confirm everything we have suspected. They will protect the banks at the expense of the people. But this time, it might not work. The hole is too big. 215 million ounces. That number haunts me. It is a monument to the greed and arrogance of the suppression cartel. They thought they could suppress reality forever. They thought they could print paper contracts and the world would accept them as metal forever. But the music has stopped, the chairs are gone, and the European banks are left holding a bag of explosives that is ticking down to zero. The contagion is coming. It will start with a headline: Major European bank halts withdrawals from commodities desk. Then it will spread to liquidity issues, then bailout talks. And all the while, the price of silver will be climbing a wall of worry, vertical, relentless, fueled by the burning capital of the bankrupt institutions. So, where does this leave us? We are standing at the edge of the cliff, watching the train wreck in slow motion. We know the actors, we know the mechanics, we know the contagion risks. Now we need to talk about the end game. What happens to you? What happens to the price? And what happens when the dust finally settles on the corpse of the 215 million ounce short position? First, you need to understand the concept of cash settlement. This is the dirty little secret of the futures market. The exchange rules allow them, in an emergency, to say, "We don't have the silver. Here's your money back at the last traded price." This is how they will try to wiggle out of the default. When the European banks fail to deliver, the COMEX will likely declare a force majeure and force the longs to accept cash instead of metal. This sounds like a defeat, but it is actually the catalyst for the super spike. Why? Because if you are a factory that needs silver to build solar panels, or if you are a wealthy investor who wants protection from inflation, you do not want cash. You want metal. If the exchange gives you cash, what do? You immediately take that cash and go into the physical market to buy real bars. This creates a double squeeze. First, the price spikes on the futures market. Then, the exchange defaults and cash settles. Then, that massive wave of cash hits the physical market, which is already empty, and the premium on physical bars explodes. We could see a situation where the spot price on your screen is $50, but to actually buy a 100-ounce bar, you have to pay $100 per ounce. The premiums will detach from reality. The paper price becomes irrelevant. This is the unobtainium phase. Silver becomes something you can't just buy with a click of a mouse. You have to know someone. You have to be on a list. The dealers will have out-of-stock signs on everything. The US banks, who are now net long, will be sitting on their physical stockpiles, the vaults of JP Morgan, and they will be selling significantly above the spot price to desperate industrial buyers. They will become the kings of supply. For the individual investor, the stacker, this is the moment of maximum danger and maximum opportunity. You will see volatility like you have never seen in your life. The price might swing $10 in an hour. You will see massive red candles as the desperate banks try one last spoof to shake you out, followed by massive green candles as the algorithms buy the dip. It will be a roller coaster designed to make you vomit up your position. Do not let them shake you out. You have to remember the fundamental reality: 215 million ounces, short versus 0 ounces available. The math is on your side. The US banks are on your side. The geopolitical trend is on your side. The European banks are the sacrificial lambs, and their liquidation is the fuel for your rocket. We are looking at the greatest transfer of wealth in the history of commodities. Wealth is flowing from the paper speculators in London and Frankfurt to the physical holders in Texas, in Ohio, in Mumbai, and Shanghai. If you hold the metal, you are the bank now. You are the liquidity provider. When the Samsung executive needs silver for the 2026 Galaxy phones, and the COMEX fails, they will eventually have to raise the bid price high enough to tempt you to sell. That is true price discovery. How high can it go? When a short squeeze of this magnitude breaks, technical resistance levels mean nothing. $50 is a speed bump, $100 is a psychological barrier, not a financial one. In a true currency crisis, just short squeeze hybrid, we have seen metals do 5x, 10x moves. Look at rhodium. Look at nickel. Silver is next. And because silver is so small, so tight, the move will be more violent than anything else. The end game is a revaluation of silver. It will no longer be treated as a cheap industrial commodity. It will be remonetized. It will be priced as a strategic monetary asset. The ratio between gold and silver, currently sitting around 80.1, will collapse. We could see 30-1, maybe even 15-1 as the desperation for silver outpaces gold. But you have to hold. The temptation to sell at $40 will be strong. The temptation to sell at $50 will be agonizing. But you have to look at the CFTC report. As long as those foreign banks are trapped, as long as that open interest is high, the squeeze is not over. You don't sell when the price goes up. You sell when the shorts have covered. And covering 215 million ounces could take months, if not years, of grinding higher prices. The US banks have set the trap. The door is closed. The room is filling with water. The European banks are pounding on the glass. And we are sitting outside, watching the inevitable conclusion of 40 years of manipulation. It ends not with a whimper, but with a default that liberates the price of silver once and for all. This is history in the making. You are not just passive observers. You are participants. By holding physical silver, you're removing liquidity from the system that the shorts desperately need. You are tightening the noose. Every ounce you stack is one less ounce they can use to bail themselves out. The era of the European banking dominance in metals is over. The torch has passed. The US banks have aligned themselves with the physical reality, leaving their old allies to rot. It is brutal. It is cynical. But it is bullish. Extremely bullish. So, when you see the headlines next week about trouble at Credit Suisse, or Deutsche Bank restructuring, or LBMA settlement delays, smile. You know what it means. It means the 215 million ounce bill has finally come due. The default has begun. Hold fast, stay liquid. And keep your eyes on the real prize, 3-digit silver. The banks have flipped, the war is won. Now we just have to wait for the surrender ceremony.